Hi everybody, so another interesting week in markets coming up. The big events that we're watching are the ECB rate decision and its impact on obviously the euro and European stocks. We also have non-farm payrolls, so that will obviously be impacting the US dollar as well as US stocks. And geopolitics, now that includes the India-Pakistan situation, Trump just coming back from Vietnam to meet Kim Jong-un, and Brexit, of course, and we're paying particular attention to the gold markets. But before that, let's just quickly run down through the main events in the economic calendar. So on Monday, we've got the China Caixin Services PMI. On Tuesday, it's the RBA rate decision and Eurozone services PMIs, as well as the US ISM non-manufacturing PMI. On Wednesday, it's the Australia GDP and US ADP employment, as well as the Bank of Canada rate decision. On Thursday, it's China foreign reserves, Eurozone GDP, and this ECB rate decision. And on Friday, it's non-farm payrolls. So then as far as the corporate earnings next week, the ones that we'll be monitoring are Salesforce, Weibo, Target, Legal & General, Just Eat, Continental AG, Greggs and Costco. So onto those three big topics for the week. First off with the ECB. Obviously we're looking at its effect on the euro. The euro dollar is sitting around 114 at the moment. So that's in the middle of its 112, 115 range that it's been in recently. It's recently moved off the bottom of that range. So sentiment been a little bit more bullish in the lead up to this ECB meeting. I'm not sure it's necessarily the ECB that's creating this bullishness towards the euro, but I do think that actually the expectation in the market has suddenly become a bit too dovish versus what the ECB have actually been saying. Markets starting to talk about the idea even of a program to add liquidity to banks, talking about no rate hike in 2019. ECB themselves not necessarily saying this. So if they keep a similar, more level approach as they have in previous meetings, that would be actually a hawkish surprise. And I think if you look at the market action, while the ECB, yes, they have turned a bit more dovish, market expectations have got a lot more dovish, but the euro has been in this horizontal range, as we mentioned. So all we really need to see is probably the ECB's continuous similar tact. And then the second thing would be see the downtrodden Eurozone economic data pick up. Obviously, the data's been very weak recently, and so that's been bringing down expectations. At some point in time, we're going to get to a point where the data picks up and easily beats these lowered expectations. And that may be the catalyst in the not too distant future for us breaking to the top side above that 115 mark in the euro. So now thinking about non-farm payrolls, taking it more from a dollar perspective, obviously, also worth considering this massive run-up we've had in US stocks. Wall Street up near record highs. As of last week, it was testing those November last year peaks. That is quite a significant resistance level. So we have to think about what will NFP do to help the level get broken or hold. I suspect that the level holds. Now we've got a few days towards the NFP. It's obviously on Friday as normal. But the expectation here is for 170K. This is the third month in a row where economists have come in with a fairly downtrodden forecast of sub 200,000, and the last 2 months we smashed those expectations with over 300,000 jobs created in the US. If we see that for a third month, then actually this expectation, actually the data's getting softer, and so the Fed need to take their foot off the pedal. That changes. So, okay, so you can interpret that from a positive perspective, that's good for US economic growth. The way I think the markets probably look at this is they think, well, the Fed haven't said they're going to stop hiking. They've just said they're going to be more data sensitive. The data is good. So that would be a worry from a market standpoint, from a stock market standpoint, that actually the Fed are going to continue their periodic rate hikes because unemployment is so low and jobs are still being created in the US. So I think that if we get another positive surprise in the NFP, that I think would be bearish for US stocks. and we see that important level hold that we just mentioned. So the last thing I wanted to mention was just the geopolitics. So the big flare-up that we had last week, which was a bit of a surprise, was the flare-up in tensions between India and Pakistan. For the time being, that's a more localized issue. Obviously, we're talking cold-blooded economics here. It doesn't have any direct impact on the commodity market, so no direct read across into stock markets. Obviously, emerging markets have done particularly well this year. And so if this does spill over into a broader conflict, and bearing in mind the two leaders of both Pakistan and India are sort of quote-unquote populists, perhaps a bit more nationalistic, they might be more inclined towards conflict. If that is the case, then I think emerging markets as a whole, suddenly you start to price in the extra risk that is associated with those markets. So it could be a negative factor for that region. And all markets are globally correlated. Actually, an emerging market factor could spill over to developed markets. And again, maybe another reason why after a decent run, the way US markets are setting up, this is the best 2-month run since 1987, at least in decades, you can say. Markets are pretty overextended, so we've got to look at reasons why they might pull over. And again, this India-Pakistan situation might be one. We've just had Donald Trump come back from Vietnam for meeting Kim Jong-un. It didn't go very well. There was not a denuclearization pact signed. It's back to the drawing table, and this is after 8 months of negotiation. So not a good situation at all there. You've got to start factoring in a Korea situation a little bit more now. And Brexit. Actually, from the pound's perspective, the pound's been rallying because Brexit is looking like we're going to avoid a no deal. But for the time being, we are just kicking the can down the road, and you can't underestimate the possibility of more upset happening and adding to that little geopolitical flare-up, something that hasn't really been a focus for markets at the start of this year. All right, thanks very much for watching. And as always, if you enjoyed this video, please sign up and follow LCG on social media and YouTube.